Hey everybody, this is Dan with Theta Trend. Today is Sunday, December 7th, 2014. It's about 3:17 p.m. here, so Sunday afternoon Mountain Time. What I want to do today is take a look at a trade in gold, GLD, for the pTheta system. And in the market commentary this week, I mentioned that I was going to be looking for a naked put to sell. So the pTheta system sells naked puts and naked calls depending on the orientation of the parabolic SAR. The parabolic SAR is this dotted red line we see coming down here. And earlier in the week, as I noted in the commentary, gold traded up through, it hit the SAR, and then it sort of sold off later in the week. And as you can see down here, this little red dot is the long signal, which is around 109.67. Let's call it 109.67. And that would be our stop level if we were going to sell a put. So basically, in the pTheta system, if we were to trade back down and below this level, then we'd be looking to cover the short put that we had sold and get out of the trade. So what I want to do today is kind of walk through a little bit of technical analysis on gold and think about this trade and just help you understand where I come from when I'm analyzing these. So right now what we're looking at is a weekly chart, and there are two moving averages, the red moving average and the gray, and those correspond to the 10-week and the 40-week. And if you're used to a daily chart, that would also be the 50-day and the 200-day moving averages. Those are the approximate measurements. So as everybody probably knows, or hopefully they know, gold's been through this pretty big multi-year sell-off here. It looks like it sort of started to stabilize a little bit in here. It's found a little bit of support somewhere around 115 or so. It broke back down through that support, rallied up, and now we really don't know what's going to happen. My opinion on gold, not certainly not that the market cares or that it matters, is that it just kind of looks like a hot mess in here. And I'm not sure what to do with it. And that's why I like having this system, because I'm going to say, okay, well, we have a long signal here. I don't know. Gold could certainly go lower. I don't know how much lower. And I'm not sure exactly when it's going to happen. So I'm going to go ahead and sell a little bit of premium and collect the time decay in that naked option. So we've looked at the weekly chart. I just want to come down here and take a look at the daily chart. So what we see here, and this is just a zoomed in version of what we were looking at on the weekly chart. The purple is the 50-day moving average. This is the 200-day. And then we have the yellow, which is the 10-day, and the 20-day is the green. So what we saw is we saw gold make this big gap down, and from there it sort of rallied back up a little bit. And two of these moves, this one here on 11/14 and also this one here, are fairly significant up days that happened on a lot of volume. You can see the volume here is the lighter shading in the background. I sort of feel like this big candle here with some stops getting squeezed out. And the reason I say that is because we had this big gap lower on 11/28. The next day, we just had this huge rally higher, and it crossed up and above this previous high right around 116. And as everybody knows, frequently people like to place their stops above prior resistance because theoretically in a downtrend we shouldn't exceed prior resistance. And so I think that some of this buying pressure in here may have been stops getting cleared out. I don't know that, that's just a theory, but it seems reasonable to me. At any rate, what we're seeing though is we're seeing a lot of gapping here in gold and some big candles. And the 10-day is above the 20-day, but that's still below the 50-day, which is declining, even though it's starting to flatten out a little bit. And the 200-day moving average is pretty close to sideways. So to me, this seems more sort of like indecision rather than extremely bearish or extremely bullish. And that also kind of leads me to feeling more comfortable with selling a put in here. So let's go down another time frame still. Oh, sorry about that. Okay, so if we come over here, what we're going to do is we're going to move down to the 65-minute time frame. And so this is an even closer picture of gold. So now we're down to the 65-minute time frame. The yellow line is the 5-day moving average, which kind of gives us an idea of what the short-term trend is. And what we can see is that it's starting to move higher, and at the same time, gold is just kind of gapping lower, gapping higher, gapping back down. And this is why I was saying earlier that gold kind of seems like a hot mess. And to me, it doesn't really seem bullish or bearish. It just seems more, hopefully, neutral with a good amount of volatility at the same time. So the parabolic SAR level is down around that 109.67, which also corresponds to this prior low. So essentially what we're saying is if we were to sell a put somewhere down below the market, if we violate this prior low, we're going to be looking to close that position because we've violated that stop level. But I've also drawn in a couple of shaded rectangles here, and these are some areas that maybe would be areas that gold could potentially find a little bit of support if it was to pull back to. And the reason I say that is just that they have found a little bit of prior resistance here, found a little bit of support in here at these levels, but then there have also been these kind of messy violations that have been rejected to the other side, or in the other direction. And so it's kind of difficult to say, but we could say somewhere around 113 to 113 quarter looks like somewhere where gold has the potential to find a little bit of support. So knowing all of that, we know our levels. Let's go ahead and take a look at the options chain and just see what we can find. I'm going to close this home screen. So let's just pull up gold here. So what I've done below is I've already pulled a couple of options into the Analyze tab, and we're going to talk about why I chose these two to look at. So the first thing I do is I always hop in here, and the pTheta system is kind of set up to sell options around 60 days to expiration, 60 to 90 days really. And so when we look at this, what we're seeing is we have something here at 74 way out in February, or we have something here, Jan 4, 15 options with about 47 days to expiration. So pretty much you can choose between 47 days to expiration or 74 in my mind. So if we go ahead and maximize this, I'm always looking to sell something around an 8 to 12 delta. And when I go into this options chain, the first thing I notice is that we don't have all of the strikes. And we only have some of the strikes, and that's probably because this is a weekly series and it's a little ways away from expiration. So we have the 105 and the 100. And that basically straddles the difference, the 6 delta and the 13 delta. So it's a little bit lower than I like to sell, and also a little bit higher than I really want to sell. But if I was to sell this, say I was to sell the 100, the credit on that's only about 25 cents. And in my mind, that's not something that I really want to sell. So I just kind of disregard that, and that's why I was looking at the 105. So if we look at the 105, let's come over to the risk profile here. One of the levels I mentioned was that 109.67. And I always like to look at and think about what would happen if price was to trade to my stop level tomorrow. And obviously we're ignoring volatility in here, but we're just trying to get an idea. So this is at 109.58. Let's just put it 109.5. So suppose price was to trade all the way down there, and it happened immediately after we sold this option, and we sold it right at that time. Then we'd be looking at an immediate loss of something around $97 or something like that. Okay, so that's not horrible, but it's not great either. So if we go look at the February option, we have 74 days to expiration, and we come in here and we say, okay, what do we have? We have something in the 8 to 10 delta neighborhood, and we want to get a 50-cent credit or so. Well, we're basically looking at somewhere between the 99 and the 101, something like that. I chose the 100 here, and we'll go ahead and tick that on. And on Friday, that closed for a credit of about 46 cents or something. So with a little bit of a pullback in the market, say that we wanted to get filled on it at 50 cents. So I'll tick it up a penny or two over that. We'd need to see a pullback to, maybe 114.11, something like that, and we close at 114.48. So that sort of movement isn't unreasonable. It's certainly possible that we could get filled on something like that. So say we got filled on that for 50 cents, and price immediately trades down to that 109.50 level. Well, if that's the case, then our loss, our T plus 0 loss, is something around $60. So the risk reward here is significantly better. It's much closer to 1 to 1. If a little bit of time passes, it probably does become about 1 to 1. So in my mind, the February series is a little bit better than the January series to sell, but that also comes at the expense of staying in the trade longer. So none of this is a recommendation to take a trade. I'm just trying to give you an idea of how I look at the options, how I evaluate them, and then also how I look at risk reward and sort of look at what the potential loss would be at the stop level if it was to get there today. So I hope that helps. Have a good rest of your weekend. If you have any questions, feel free to post a comment on the blog or shoot me an email, info@thetatrend.com. Thanks.